This next panel, we're going to take a closer look at the early stages of a company and discuss the concept of product market fit, as well as the approaches to targeting and building a customer base. So to speak on this topic, we're going to have Jon Fjeld moderate. Jon is the Executive Director of the Center for Entrepreneurship and Innovation here at Fuqua and a tech industry veteran. And the panelists include Tim McLauglin, a partner at Cofounders Capital, which is an early-stage seed VC fund focused on software ventures in the Triangle. Kyle Mumma, who is the founder and CEO of NextPlay, which designs and delivers customized career development programs that empower student athletes to capitalize on their skills, as well as him being a recent Fuqua grad. And Mitchel Goerecki, the founder and CEO of Livinglabs, which is a shared living software platform offering per-room leases and furnished property, and another recent Fuqua grad. So please take it away, Jon. Thank you very much.
Thank you. Thanks to all of you that are here. Let's just take a minute and you guys can each say something about the venture you're in. And Tim, you can say a little about Cofounders Capital, but Kyle, why don't you start and tell everybody what you're doing?
Yeah, my background is mostly in sports. I worked for the basketball team here, the football team here for a number of years, and saw that transitions were a challenge for student athletes. It's something Zach Morides mentioned earlier this morning for those of you who were here. When I graduated Fuqua, I developed a career development program for the football team here that was really successful and impactful, and decided to start a company aimed at kind of replicating that service at other schools across the country. So I'm in the early stages of building that business.
I think similar, kind of creating a company out of a need. Actually, I think we've shared every single year of education together
Mitchell
at this point
and I
in
have
our
been
lives.
in school together since kindergarten, including Fuqua, including undergraduate. We were in the same section at Fuqua. Now we're on a panel together.
This is hysterical, so I can't get away from you. And now we're in the same office, actually.
Yep.
So when I transitioned from undergrad, I wound up, like many people, trying to find housing and realized just how much difficulty there was there. It's very expensive. A great way to cost mitigate is through roommates, but it's very hard to simultaneously find people and property. And so through helping friends doing this and then charging a commission for it, realized if we could create a marketplace, it would be far more efficient and very lucrative. But ultimately decided that getting an MBA would be very helpful in pursuing that venture. And so now post-MBA, turning this into a company.
I'm Tim McLauglin with Cofounders Capital. So we are a seed stage venture capital firm here in Cary. We just closed last week on our second fund at $31 million in our second fund. And so we're looking at very early pre-revenue or maybe just at revenue companies, B2B software companies, primarily in North Carolina, but in the Southeast, to invest in. I've worked with Mitchel before on some stuff, and I'm getting to know Kyle. And maybe just interesting to tie it all together, I played hockey undergrad at Harvard. And then I spent so much time in the gym and on the ice, I had no idea what the hell I was going to do after college. So I guess I became an entrepreneur since I didn't do well in the recruiting process. So started a hockey training venture, and that led me into my entrepreneurship path and later into VC. So.
But did you have an apartment, or did you live in a cardboard box?
So 98% of people at Harvard live all through senior year live in university housing. So I did not feel the pain point that Mitchel is trying to solve. So.
Okay, that's great. So product market fit, obviously the foundation of any venture. We have two entrepreneurs and an investor. I thought what we would do is ask our two entrepreneurs to describe whether they have product market fit and why they believe that they do, and then ask our investor to say whether he believes them or not. So since you know Mitchel, we should start with Mitchel, so Kyle's pitch will be freshest in your mind. So go ahead, Mitchel.
So I would say when pitching and raising money and speaking to an investor, we absolutely have product market fit. Whether or not I thoroughly believe that or that direction is solidified and concrete, there definitely is a lot of room for improvement. But for sake of discussion, I'm going to go with yes.
Okay. You're going to explode. Okay. Just yes, or you want to tell me why? Yeah. I can fire rapid fire questions, but why don't you take a shot at it?
So I think when coming up with product market fit, there's a lot of pieces that have to align. And maybe I take this at a very basic approach, but you have to identify your market. And you have to identify what is the problem you are solving in this market and how much value is there. And then given your process or company, can you capture a percentage of that market or transfer that value between people? And so in our case, we had the set of assumptions that there is demand for housing. Effectively, everybody needs a roof over their head. It is a very large expense. It is a large market. And ultimately, there's a lot of pain points in creating that transaction. And so then the big question was, can we build a platform or a tech company to make this easier? And then easier is a bit of a loaded term, right? Can it be quicker? Can it be a more efficient process? Can the funds transfer hands more efficiently? Or are you finding a more appropriate price point where no one is being taken advantage of, be it arbitrage or an underpriced asset? And so we have built a platform, and now we have presented that to our user base. And initially, in my opinion, it was a big flop. We did not do a very good job. We couldn't get transactions on platform, and it was this big question of why is this not actually working? And through iterating on that product and trying to understand what the process was in closing these transactions, we've gone from what am I doing to actually closing transactions, capturing value, and getting repeat business. And in my opinion, that transition, after you've developed that product, identifies that you've begun to achieve product market fit. Do you ever achieve 100% and you are permanently there? No, I don't think so. I think there's always room for improvement. But I would say in context of building a product that can become a scalable company, yes, we have achieved that.
Okay.
Kyle, you want to take a crack at it?
Sure.
And,
yeah,
go ahead.
I think part of the advantage that Mitchel and I maybe both have is that the businesses that we've developed came from a need that we saw firsthand, that we experienced firsthand. So when I was recruiting for Duke football, I used to tell kids and their parents all the time, make a 40-year decision, not a 4-year decision. Come to Duke, and we'll set you up for the rest of your life. And then I would watch those kids go through the program, and they would focus on football. They wouldn't get the same type of education that many of their peers would get. They would leave school underemployed or unemployed, and I felt, frankly, like I was selling a false bill of goods to those kids and their parents. And so I knew that there was a problem to be solved, because I knew if Duke wasn't doing that well, that many other schools were also not doing that well. Part of the reason I believe I have some degree of product market fit, I'll kind of put an asterisk on it like Mitchel did, is because I've now run a successful program at Duke that has started to show, via some of the metrics that we track, that it's delivering on the impact that we're promising to the school. So we try to give knowledge, skills, network, and confidence to football players. Those are kind of the 4 areas that we measure in, and we've been able to show through our first year that it has had the desired impact. It's had a recruiting lift. It's had a fundraising lift. So we've proven that we can both solve the problem and deliver value for our customers, which has led now to us being referred to other customers. And now we have a handful of clients rather than just being here at Duke. By growing organically like that, I think it's helped us to achieve some degree of product market fit. I think the other benefit that we have by being a service company is, I can scale up or down the offering to match different customer segments, which is now something that I'm playing with. So, a larger Power 5 school has a different set of needs than Campbell University in North Carolina, which is one of our clients. So being able to kind of play around with, okay, what are the common needs between these larger schools, smaller schools, big money schools, small money schools? How can we find some efficiencies in those common needs? And then how can we also address some of the unique concerns that each of them has? Allows us to kind of continue iterating on that product market fit and ultimately get it to a point where it can be a little bit more large scale workable.
Tim?
Okay. Well, I think if you guys don't mind, I might ask a couple of questions from both of you and just kind of do a little bit of rapid fire. That's a good pitch there, and then you really got to kind of start digging in to understand whether these companies have product market fit. And just as a reference, when we invest, we're investing in pre-revenue companies normally. So I know there's not product market fit there. But my goal is to test assumptions as we go through this and get companies to a point where they kind of have that product market fit or starting to show that, so that we can raise another round of capital at the A round and then grow into the B round, where we can more say, here's the money we're going to put in, and here's what we kind of know is coming out of it. right? What the output's going to be. Whereas when we invest initially, that's a hard thing to do when companies are pre-revenue, okay? So I'll ask a same question for both of you. So who is your customer and how many customers do you have? You're paying, and just to clarify, who's your paying customer?
Right,
which is a big difference.
So I was going to add clarity, and then one of the big problems that we actually had was defining who is that customer. And we took the perspective of the customer is the individual who, at the end of the day, is parting with money for your service, and you are capturing that value. And so if you take our business, we have tenants who effectively pay their landlords for the rental property, but the service portion that we are providing is directly billed to the tenant. So in our case, the tenant is the customer. And so we have about 1,100 users who have used the platform to try and find housing. And we've converted 45 of those into paying customers. And then we've iterated through many different models. And so we have now settled on the one that we think gives us the best product market fit. But that's a whole nother discussion as to understanding the risk, the reward, and the trade-offs between those. And so I'll give a good example of, let's say you have a home where one person has committed to rent one of 3 bedrooms. Who is holding the vacancy risk on the rest of the property? Is it that tenant? Is it the landlord? Or is it Livinglabs? And so if we take on that risk, you can then upcharge for those bedrooms, but you are also liable for the vacancy risk. And so the question is how much risk does the company actually want to take in deciding which business model to pursue? Because the alternative would be is just having a percentage fee for the transaction. And then going from there, finding an investor who is aligned with that vision, believes that that is the correct model that achieves the best product market fit.
Okay.
So when we have some grand visions of who our customer may be one day, I would say right now we are focused on the 347 Division I college athletics departments. We have half a dozen of them right now who are paying for a program. We have another 4 or 5 that have brought us in either for a one-day workshop to kind of test out the service that we provide, or who have brought us in to do a needs assessment, who have basically said, we've seen what you've done at other schools, we like it, would you come in and identify what you might be able to do for us in that same vein. So our customers right now, we found the most success with smaller private schools, Duke, Campbell, Furman, Elon, Davidson, trying to keep it as regional and contained as we can at the moment as we continue to kind of iterate on the service. It helps us to leverage resources a little bit more efficiently. I am fortunate to use a lot of the resources here at Fuqua. I've had folks from the CMC and faculty members who have gone to some of these other programs with me to help deliver some of our content, which is really beneficial for us. But our initial customer base that we're targeting is Division I college athletics departments, and we've got almost a dozen of them on board in some paying capacity.
Okay. How do you see moving forward, right? Maybe not how it's been or how it is today. Moving forward, how are you going to price, right, your customers?
So in our case, everything is supply and demand driven. And on 2 levels. One is the underlying asset as a whole, the house, and then the per bedroom cost. And so you can imagine if Kyle and I are splitting a place and I'm living there for a year and he's only there for 6 months, there is some form of prorate, but it isn't necessarily that Kyle is paying twice as much as I am paying because you have that empty period. And so we use supply-demand driven pricing with constraints on minimums such that we can actually meet the cost to service that property. So a good example is no per room pricing will ever be less than a $217 premium, because that quite literally is the cost of utilities and furniture.
Okay, so give me an example of a house with 3 rooms and 2 folks are sharing that room, and go ahead. It's $1,500 a month. I don't know. Give me an example with our numbers.
So each room is priced based on the underlying demand for that property. So we will look across the entire searching pool to see how many people could possibly match into that property at what price, and does that price, given the possible combinations, meet the rental obligation on the home, and then plus some percentage that fluctuates based on how much demand there is. And so if, let's say we all have internships in Palo Alto, and we're all trying to find a property, the landlord will benefit because the price per room will go up to meet that demand.
And you're making your money off of the amount of money, the spread?
Correct.
And a percentage of the spread?
Correct.
Okay. What's the percentage?
It widely varies.
Okay. Okay.
So our model
That's what I was getting to.
our model is three phases. A discovery phase, we go in, interviews, surveys, kind of identify what the challenges are, where we can add value. A design phase where we put together a curriculum for the next year that we specifically designed to address some of the challenges identified in that discovery phase, and then a delivery phase where we actually go execute on the programming that we've designed. Because I've done a couple of these now, we've been able to build out a model knowing how much, I mean, essentially manpower is the input that we're paying for. So I've got a good sense now about how much it costs us in terms of labor to provide the service. And so that allows us to kind of scale our price up or down depending on what the client might be able to pay for. If they want to do 25 sessions in a year, 25 workshops, 10 for the men's basketball program, 10 for the football program, and another 5 for the rest of the athletics department, that'll cost something very different from a school who wants to do 2 one-day workshops open to all of their student athletes. Our average deal size right now is in the $40,000 neighborhood. We're hoping to get that up closer.
For all 3 phases?
Correct.
Okay.
We're hoping to get that closer to $60,000. I'm pretty comfortable in that price point.
What's the top end of that and what's the bottom end?
So the top,
$40K.
Top end currently is $70,000, and then the bottom end of that is $1,500.
Okay. 1,500 or
1,500 for a very small workshop. So our price will fluctuate a pretty good amount based on what the schools want, but I feel pretty comfortable in their willingness to pay for the service to varying degrees.
Okay.
So Tim, do you like the answer so far?
Well, I think I have an answer in my head as to whether there's product market fit. And so, if I kept asking these questions, basically what I'm trying to do is I'm trying to say, okay, here's your universe, right, of customers that you could potentially have, your total addressable market, say. What's your segmented market that you're going to go and attack there, right? And how repeatable is the model that you're doing right now? And how sure are you on the repeatability of that model? Okay, that's ultimately what I'm trying to figure out. I mean, I invest in pre-revenue companies, so you guys will not take this as a knock. But I would say that neither one of them has found product market fit, because the longer the answer is to who your customer is, how you charge, who you're charging, the less product market fit you have. Ultimately, that's what it comes down to. And so when I ask an entrepreneur in a meeting, I say, okay, what's your average price point? Well, it varies widely, right? Which is classic. Okay, so you don't really know what your pricing is at this point, or who's your customer? Well, we actually have three types of customers. Well, how many total customers do you have? Well, 3. Okay, so you have 3 unique customers, and that's okay as long as you're measuring and you're honing in on what that product market fit is. I mean, that's how you grow and scale a business. So. It's nothing new, but that would be my answer.
Can I ask a follow-up question on that?
Yeah.
So when you speak to an entrepreneur, would you rather hear, like, would you have preferred to hear me, for example, say, oh, our average deal size our price is $40,000, right? Or would you rather hear some color around that, how we're getting to that number, what it may or may not look like in the future? Like, which is more of a red flag to you?
So I have a answer that I believe in wholeheartedly and is very important to me. When you're telling your story as an entrepreneur, always build your story up, okay? So you're going to want to start and say, like, if I was Mitchell, I would start and say, I've had 45 paying customers for this, right? I've had 1,100 users out of this, right? And it's worked across this many properties or whatever it is. Because then as an investor, I'm saying, okay, that's impressive. Oh, that's even more impressive. Okay, that's even more impressive. Rather than saying, I have 1,100 users, only 45 have paid for it. Based on how you frame that, you either think it's really good or it's not quite as good as you were hoping it was, right? And so I guess to answer your question, if you were to say our average deal size is 40,000, our top deal is 70,000, and we have 6 customers, right? That are, and now I'm saying, okay, I know what kind of the average deal size is. It gets better because I know you can charge somebody $70K, and I know you can charge 6 people some amount of money, right? That's kind of how I would consistently tell that story to make it seem better. Maybe trick the investor or something. I don't know.
Yeah. You know, so I'm going to make a little editorial comment here. I think if you listen to what Tim has just said now and what he said before, one of the really important things that surprises me that young entrepreneurs don't get is they don't ask themselves, what is he actually trying to understand? What is the question that is really that he's really asking me here? What does he want to know? And you know, Tim's done a nice job of explaining what he's trying to get out of this question. And you need to understand what that is as opposed to focusing on the literal question and giving all of the detail that, and this happens so often. I know so much, let me just start talking and see how much of it I can get out. That's not what he's looking for, right? What he's looking for is very succinct answers to some simple questions. And understanding that helps you communicate much more effectively.
And I think the investor's ultimately going to get to that answer. Whatever that answer is, the investor's ultimately going to get there. So even if it's an answer that you don't like to give, right? Like this happens all the time. How many customers do you have? Okay, I have 2,000 customers. Okay, well, how many of them are paying customers, right? And then it's, well, let me explain to you, starting back in 1998. And I'm like, no, that's not what I asked. Like, how many paying customers? There's an answer to that. And if you don't know what the answer to that is, you're probably not going to be a successful entrepreneur because that's a metric you want to be tracking every day. So eventually, I'm going to repeat that question and ask it in a different way until I get to the answer, right? So start with the answer, right? And we can move on.
Right.
So.
And I'm going to make another comment, then I want to throw it up for some questions. One of the things that's not obvious is when you're looking at product market fit, there's 2 questions that you're answering. One is what's the market, and the second is what's the product. And you iterate back and forth. And when you get a negative signal, it might be that the product's wrong, it might be that the market's wrong. And it's much better to have a really good fit with a smaller market to start with than it is to have this thing that's sort of vacillating between lots of different needs and different segments, as opposed to, you know, right now we have got a solid solution for schools that look like Duke University. You know, this much money, this many students, this kind of profile, and we have got that licked. And so we have product market fit right here. Now, is that a huge market? Not yet, but you know, here's how we're going to move, you know, conquer the next. And that's, I think, a much better strategy than a scattershot approach that has some positive and negative signals in it. I don't know if you agree with that, Tim.
So I think that, especially with the stage of companies that we're working with, is going after everything is not a strategy. But testing 3 different go-to-markets and then saying in 4 or 5 months, we're going to shoot 2 of those in the head and attack one, that is a strategy. Right. That is saying, I'm not exactly sure right now, and this is exactly what Mitchel did. Yep. He was talking about pivoting and stuff, but he's honing that in. Right. But he's not going here and then going over here and then going over here. He said, okay, for the next 5 or 6 months, let's get data back on these 3 different potential go-to-markets. And at the end of that 6 months or whatever it's going to be, we're going to have a better idea which 1 or 2 we're going to attack, and then we're going to hone it in again.
So I was talking to Zach from Teamworks this morning, and we were having a longer conversation, but his main piece of advice for me this morning was quit trying to sell for the time being. His main piece of advice was you've got a customer base that represents some different segments of the market. Spend the next year delivering to those customers, iterating on the service, and getting to a point where you have the answers to what the right service to provide is for which schools, which I think is kind of in line with what you guys are saying, where rather than obsess over growth to the point that you're not actually delivering value to the customers you have, be a little bit more intentional about finding that fit as you go.
The one thing we can open it up, but just when I ask somebody to pitch their business or when they start out, ultimately I get back to who's your customer and what is the quantitative value props to your customer. Okay, is it better, faster, cheaper? If so, by how much, right? And how to quantify that against something else. All right. Ultimately, that's what it comes down to. What value are you creating for your customer? And if you can have multiple customers and a repeatable value props, quantitative value props, how much money you're saving them, how much time you're saving them, how much better it is than their alternative that they're using right now, Now that is ultimately how you're defining product market fit. So if you have 6 customers and you can say, on average, we placed this many more folks into careers. They were the average starting salary of our non-NBA playing, graduates was this. Okay, now if that number is starting to get tighter and tighter and tighter, now you're finding product market fit.
Right. Any questions?
Yeah, team. So,
Here. One second, let me pass you the mic so you can.
Just throw it at them.
Yeah.
See everybody's hands here. Kyle wants to work with athletes.
well, I'm not one. So okay, I'm trying to, okay. You said that you were investing in pre-revenue startups.
Yeah.
So in that case, what the discussion is about? Because I'm guessing it's not.
What is what?
Where the discussion is about with the entrepreneur? What are you looking at? Because there's no facts, just kind of assumptions. So I don't know if it's your gut telling that the assumption of the entrepreneur is right. What? I don't know.
Yeah, no, it's a good question. So Mitchell kind of knows this because we try to give him money, but someone else wanted to give him more money, I think. So that's okay. He went the right path. But so what we do is every business is built on assumptions, okay? And ultimately, the value of your company gets greater and greater the more you can prove those assumptions to be true. Is that fair? So if I have 10 years of the same growth that I'm going to have, my value of my company is going to probably be more than if I have no data at all. So what we do is we base the company and the growth on a series of assumptions. And the conversation with the entrepreneur is how do we go about proving those assumptions or getting comfortable with them that we're going to give you the right amount of capital to grow this business to a certain point. Let me give you an example. Some of the assumptions that are really important. Sales cycle, price points, average deal size. So maybe you're pricing on a per employee per month basis. What's your average customer going to look like? And so those are assumptions that really drive your business model forward. So what I'll do is I'll go talk to 30 potential customers, right? And I'll say, hey, so-and-so said that this software can save you this amount of time or make you this much more money. Do you agree with that? Do you think that's true? I mean, this is very high level. And they say, no, not a chance. Okay, well, that's one red flag. Now let's go talk to 29 others and see if they say it. If they say yes, I'm like, hey, if you wanted to implement this, about how long would it take you to be up and running and paying for this? And I start asking those questions in diligence, right? If this saved you 30% of the time of this employee, how much would you pay for this every month? Okay? And now you're getting 30 data points around some assumptions, and then you change those assumptions accordingly to see how it drives your model moving forward. Maybe you need more money, maybe you need less money, maybe you don't have a business. Okay? And so that's what the discussion is around. But before you get into any of those, you have to kind of have a feeling of what your value props are to your customers so you can test them. Yeah.
I think the other big piece I would add to that, because I completely agree, it's this kind of it's a chicken and an egg problem. And in our case, I pitched an idea, and there were a lot of assumptions behind that idea. I mean, I think I pitched you on a napkin almost at one point. And the discussion was, okay, well, what can we do to prove some of these assumptions? And one of those is, okay, well, what is the premium that an end user would be willing to pay? And if I just say, hey, Kyle, would you be willing to pay X? He may say, oh, yeah. And I go, okay, well, here's X. And he goes, no way. And so really the best way to test and validate those assumptions is to go and do it, which in my opinion was one of the biggest jumps of going from 0 to 1, so to speak. And so in our very particular case, I went ahead and would rent property and then find the people to match into those, knowing that I was the liability holder on that unit if I didn't do a good job filling it. And that was how I was able to prove out what does this market actually look like and are people willing to pay for it. And I found that actually going and doing it, even if they were small numbers, was a great way to start that conversation to better understand what the willingness was in the market.
David.
So Mitchell, this is for you. I know we're talking about.
You got to speak into the mic.
Oh, sorry. Thanks. So this question's for Mitchell. We're talking about having a narrow focus and testing this one assumption for your product market fit. But since so much of your product is a very tech-heavy platform, as you're building it out, are you thinking about the different pivots that you may need to make down the road and building those into the platform and taking that extra time to build those in? Or are you building your tech just to solve that one assumption that you're solving for?
So I am very much so of the opinion that the technology of a company is not what makes it a company. It's the balance sheet and the cash flow. The technology is what makes it move faster, so to speak. And so in our case, I mean, I quite literally started with, I spent a summer in Feld's office making 400 phone calls to people who I knew were going to move to Durham the following year. And said, hey, can I put you on a list where I'm going to match you into housing? No, I don't know who you're going to live with or what house you're going to live in, but can I call you in a month? And that list became 200 people, and I called a bunch of landlords and said, okay, well, hey, if I gave you people, would you be willing to pay me a spread, a commission, or do I need to guarantee the rent on this? Now I had 10 homes, and I just went back and forth and back and forth. And in iterating through that process, it took me forever to close deals, but it helped me understand what was the technology that needed to be built to scale those operations that enabled me to capture that value.
And since this is one of my hot buttons, I have to add a little bit on this. These aren't tech companies. Mitchell certainly is not a tech company, which is why, and when people get focused on, I have a tech company, therefore the first thing I have to do is build technology, you're making a mistake, because this is a service business. The value is the people you rent with in the room, and you can test the elements of the value proposition, back to what Tim was saying, by faking it. You don't have to build technology to test whether the value proposition will resonate. You can't scale without technology, but you can demonstrate that you have value without building the technology. And I think too many people get tripped up building technology when that's not the key assumption to be validated. Everybody knows you can build the technology, but they don't know that people will pay for what you're delivering, which is, back to the very point Tim was making.
Two quick comments on that. So typically, the first point is the conversation we have with an entrepreneur, a lot of times is they come in, Connor comes in, and Connor's talking to me, he's pitching his idea. And I said, well, okay, what do you need $500,000 for? And he says, I need it to build the technology. Wrong answer. Don't care. Let's go mock up some screens. Let's go see if we can sell the value props of this. And if we get 20 customers that are nodding their head, the technology is just a product of time and money. Yep. We have some time and we have money, so let's go make sure we're building what they want.
Right.
Now, the second point is we have 21 companies that we've invested in out of the portfolio. I'd say we've completely thrown out the code for half of them that built it before we made an investment, because they came in with a product, right, trying to find a problem, right, instead of starting with the problem first. And if you have $200,000, $300,000, $400,000, $500,000 into your company and that code is worthless because you built technology that nobody wants, it doesn't improve the valuation of your company, right? We're going to throw that out and we're going to start from scratch.
There's a company in my space that tried to solve this problem with technology, and they made that exact mistake. They tried to launch a platform for student-athlete career development. It flopped because it didn't solve the need, which eventually, for me to make this scalable, I will have to have some sort of technology to enable it. But I'm not going to sniff that conversation until I understand really how I can solve the need and make sure that people are willing to pay for it.
Right. And do you, just to follow on, have you found big differences between Davidson, Duke, Campbell?
In some ways, but not in as many ways as I would have expected. It's not going to be that challenging, I believe, to come up with a methodology that makes sense for a fairly wide variety of school. I do think the challenge is going to be there's value in the customization, and they like that customization, which is expensive to do in a service model. So it's finding that balance is going to be challenging.
Yeah. Okay, very interesting. Other questions? These are good, by the way.
I do think I would echo, in pitching and raising money, I don't think a single time, and I think I've spoken to maybe 280 investors, somebody said, oh my gosh, let's open up the product and see what it looks like. Not once. Yeah. It had nothing to do with the product. There were assumptions about the market we were going after, and how could we be on the capturing side of that value. And to the point of, as code gets rewritten, everything gets changed. Is this a scalable, sustainable business?
We have a company right now that we're about to invest in, although I've been told I shouldn't invest in it from some Fuqua MBAs. But we are going to make an investment in it. And about 60 days, about 45 days in our 60-day diligence process, we had the code review scheduled. And we went in to do it, and they go, why are we scheduling a code review? And they've had mocked up some screens, and they literally didn't have. They had a few lines of code written. They had a little demo product, and it's not going to stop us from making the investment. I know that might sound crazy. We maybe gave them a little bit higher valuation than we should have, but like you're saying, the very first thing is not the code is just time and money. It's about the value props and talking to the customers first.
If you're starting a pharmaceutical company, it really matters whether the solution works.
Yeah.
If you're doing one of these fairly standard tech companies, nobody wonders whether you can build a website or an app that does something fairly simple.
No, I think I've had 2 people truly interested in it, and partly because both of them were head of product of prior companies.
Yeah, right.
One last question.
So how do you bridge that gap? So how do you bridge that gap between, because what you guys are saying is that the product is not important, essentially, that you can rebuild it, you can retool it, but when you're going to customers without a product, it's kind of difficult to get them to sign off on anything or to even pay for something that's not necessarily there yet. How do you bridge that gap as a super, early start?
So I'm going to just change and just so you know, kind of our philosophy, when we start working with a company and get in diligence, all we try to do is work with them to help them sell their product, get customers, and grow their business. It is not tedious diligence. It is, let me go sell with you for 60 days and see how many customers we can line up. So I'm very familiar with doing this across a lot of companies. You have an opportunity before you have a ton of code built to be we would love your advice and feedback, and you as an industry expert, and calling people an industry expert really helps. You're the expert. I need your advice and guidance and feedback. Here's a product we're thinking about building. If we built it, now you can say, if we built it, what would you want to see? If we built it, how much would you pay for it? Versus, I'm coming to sell you right now, right? And so bridging that gap, mocking up some screens, here's what we think it would do. Is there anything you would add to it? How much time do you think this could save you? I mean, those are the real questions that you want to get at, and it's not as much of a sales pitch, which early on can be a big advantage.
Right. And I'll let you guys add, but nobody here said the product wasn't important. What we said was that the tech wasn't the product, right? The product is the service offering, the value that's being delivered, and I think it's separating what's the value I'm delivering to the customer to what's the tech platform that enables me to scale it is the thing that a lot of people have trouble separating.
So you're saying instead of the product being like an app, it's the product is that service?
Yeah, it's an app. It's an information service. It's a connection service. It's it's the value that you're getting out of the app that matters, or out of the website. It's not the thing. It's the tech itself that matters to anybody except the engineers who are building it.
Yeah. And they're never going to think it's good enough.
Any last thoughts from you guys?
No, I would echo that. In that schools that I've talked to are, I use that same line, right? Like, you guys know student athletes better than anyone. Let me work with you as a partner to develop a solution that makes sense for you, and that is just as attractive, if not more attractive to them than it would be if I said, here's my solution to your problem. Will you buy it? It's the early stages. It's kind of fun to work with them on helping build the solution that they need rather than the solution that I want them to need.
Yeah, you're a value-added consultant early. You're not a salesperson.
Okay, I think we're out of time. Thank you all very much. Let's thank our panel. I thought very good discussion. Way to go, guys.